Chapter 6: Business Organizations and the Tax Environment. Learning Objectives. Describe the different forms of business organization and give the advantages and disadvantages of each. Discuss the goals that firms should pursue and whether firms always pursue appropriate goals. Discuss the role of ethics in successful businesses. Explain why it's important for a business to have a clear corporate governance policy. Explain how foreign firms differ from U.S. firms. Explain why it's important to consider taxes when making financial decisions. Alternative forms of a business organization. Proprietorship, an incorporated business owned by one individual. Partnership, an incorporated business owned by two or more persons. Corporation, legal entity created by a state. Corporation is a legal entity created by a state. The advantages of corporation include separate and distinct from its owners, unlimited life, easy transferability of ownership, stock represents ownership, limited liability, easier to raise money in the financial markets. The goals of the corporation. The goals is stockholder wealth maximization, considers the risk and timing associated with expected cash flows to maximize the price of the firm's common stock. Agency relationships. Owners or principal hires an agent and delegates decision-making authority to that agent to act on behalf of the principal. Problem exists when there are conflicts of interest between them. Corporate income taxes. Interest and dividend income received by a corporation. 70% of dividends received by another corporation is excluded from taxable income. Interest and dividends paid by a corporation. Interest paid is a tax-deductible expenses. Dividends paid are not tax-deductible. Key business organizations and tax environment concepts. What are the different forms of businesses? And what are the advantages and disadvantages of each? Proprietorship and partnership, easy to start, but unlimited personal liability. Corporation, difficult start, but limited liability. What goals should firms pursue? Maximize stockholders' wealth. What is the role of ethics in successful businesses? Established codes of conduct help ethical firms prosper, whereas unethical firms do not. Why is it important for a business to have a clear corporate governance policy? Rules for managers help stakeholders have a clear understanding of how executives run the business and who is accountable for important decisions. How do foreign firms differ from US firms? Foreign firms have more concentrated ownership. Manager finance factors that distinguish domestic firms from multinational firms. Different currency, economic and legal ramifications, languages, cultural differences, and the role of governments and political risk. Why is it important to consider taxes when making financial decisions? Because taxes must be paid in cash. The effect of taxes on cash flow must be considered.